Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is our 75th episode, Market Outlook for 2020. Jesse, welcome back to the show.
Thanks for having me on.
It's been a while, hasn't it?
It's been a long time.
You've been really busy trading and rebalancing and researching.
I have been very busy.
And you just sit on the other side of our studio here, so we need to bring you on the show more.
Yeah, that'd be great.
So today's show is all about the market. We wanted to kind of take a deeper dive into what in the heck happened in 2019 and where we see things moving forward. So why don't we just dive right into it? I mean, for people tuning in and watching this on YouTube, or if you're listening to this on a podcast, and if you have any awareness to what happened, the stock market was a heck of a year. I mean, it was up almost 30%. And if you're not working with us, or anybody that's working with an advisor has any money in the market, whether you're doing it yourself in your 401k, you probably should have had a good year. But I want to know why. I want to kind of unpack briefly before we get into 2020, why in the heck did the market do so well?
So a lot of people are attributing this to the Fed. So the Fed was lowering rates throughout the year, and that typically only happens when we're in a recession. And they did it when the market was basically at all-time highs and the economy wasn't in a recession, but it was slowing, but we still had positive economic growth. So that was a kind of a divergence from what the Fed has typically done. And the economy was also doing well. I mean, the unemployment was at a 50-year low. So it was an interesting time for Fed to be lowering rates, but that kind of drove the rally, and people were looking for yields. So the yields on bonds weren't as good as they were previously. Right. And that had a lot to do with bonds appreciating throughout the year. So a lot of investors were moving into those risk-on assets and into stocks because they were looking for yield that they couldn't get in other places.
Yeah, it makes a lot of sense. So if we flash back even further, so in 2018, the Fed, they raised rates. Mm-hmm. So we thought they were actually potentially going to raise them further in 2019. Mm-hmm. And then Jay Powell, the Fed chairman, I think he got a lot of pressure from Trump.
Yes.
And he ended up lowering them 3 times.
Yeah.
So then what you're saying is then bonds appreciated and investors couldn't get yield. So they went in and they started buying dividend paying stocks, mm-hmm. right? Instead of getting 1 or 2 or 3%, maybe they could get 3 or 4 or 5%.
Right.
And that's what kind of continued to drive the market up.
Right.
Makes a lot of sense. And that's a good reason. If you remember, things were pretty bad in 2018. Pretty much, broadly speaking, most all asset classes had a negative return. So some fear had picked up. There were talks of recession, but we didn't get out of the market. And that's very important. Again, you can never time this thing. So we just stayed with our knitting. We made some good trades on our stock portfolio that ended up working out for us and our clients nicely. And we had a nice rally, and we really enjoyed 2019's returns. So I know in the fourth quarter, you and I started rebalancing, mm-hmm. Because the whole idea is that we don't want to what's called round trip it. So we don't want to ride the market all the way up and then just ride it all the way back down. So right. We want to capture some of those gains at the top and put them back into some other asset classes that haven't done as well. So now that we've had a good year and we're winding down our rebalancing for all of our clients, what are we looking at for 2020? What's on your radar? What are you paying most attention to right now?
I think I'm looking most at value. So value started to perform a little bit at the end of the year, and I want to see value stocks kind of expand. So as the economy slows down a little bit, investors are going to be looking a lot at valuation, and growth performed really well in 2019. And I think investors have been trying to make this call for years now because growth has been outperforming. But I think we could see value make a comeback as investors are more focused on the valuation of stocks. So I think I would like to see value make a comeback in 2020.
Yeah, and this is a perfect time during our show that we'll go ahead and put a picture up of our Kalan chart. And I think you're right. Isn't it 2 years in a row large growth has been the number one performer?
I believe so. I know that growth stocks have been outperforming value for a year.
Right. So if you're looking at this chart, I believe growth, and it was mid-cap growth was towards the top also, right?
Mid-cap growth and large-cap growth.
Right. So they both beat, and it's been like that, I think, for a year or two, at least on the growth, like you said. So it's a pretty bold call that now we want to circle out. So we want to take some money out of those growth stocks, and we want to go in towards the bottom of the chart and buy some of those value stocks while they're low. And there makes a lot of sense. So again, more of the point to rebalance. And you're right, if the economy slows down, we're looking for value companies to benefit from that.
One thing that we saw in 2019 is that a lot of those tech companies that were going public that didn't either have positive profits or at least a path to profitability, investors weren't really trying to invest in those stocks. And I think that could precipitate what could happen with investors switching from growth to value.
So you would argue that the individual investor maybe is wising up a little bit and a little bit more cautious on just dumping their money into the next hot tech stock?
I think they're starting to worry more about valuation now that the economy is slowing down a little bit.
Yeah, makes good sense. Okay, so what else is on your radar?
I think gold could have another rally. So gold hasn't been a loved asset for a while now, but we saw a little bit of a rally with the Iran-US conflict. But that was something that had been going on in gold for a couple months.
Right.
So I think gold could perform also in 2020 because, again, when we're talking about those bonds, they appreciated so much in 2019 that I think investors will be looking for a different risk-off asset to invest in to protect their portfolios.
Yeah. And so again, at Falcon Wealth Advisors, we like gold as part of a diversified portfolio. It's not simply something we want to buy and hold, though. I think it's a trading entity. So the idea is that we may be looking at, for certain clients, maybe overemphasizing gold in their portfolio to pick up some more of that return that Jesse's talking about. I think you're right on that. It does make a lot of sense. Gold, I don't know if you knew this or not, is one of the worst performing asset classes of all time. So again, we don't believe in having a significant weighting or buying and holding it, but we do want to trade it. And so maybe this is a good time to trade into it and see if that helps our overall portfolio performance a little bit.
Right. Yeah, and it's been essentially stagnant for 10 years now, and but we've just started to see them kind of break above their support levels and their resistance levels over the past couple of months. So I think it's an asset to definitely keep an eye on.
Yeah, okay, good. What else?
And then I think one of the most prescient things that we've seen in the past couple of days is the conflict between the U.S. and Iran. The U.S. basically assassinated one of their top generals, and that has not gone down well in Iran.
It's crazy.
And that could start another Middle Eastern conflict, which the market sold off on the day that it happened. So I think that's something to watch as kind of the fallback from that comes in from other countries, including China, Russia, Iran, Iraq. So it could be a world conflict, and it's kind of interesting to see or important to watch what happens with that.
Now, historically, war has been good for the economy and the market. So would you argue that maybe as things ripple through, if we ended up going to war, that'd be horrible on a human standpoint, but economically speaking, it might not be so bad, right? Because doesn't it keep people working and manufacturing goes up and we're making weapons or planes or using fuel or whatever that may be?
Right. You did see companies that are in the military or defense sectors kind of rally on those days that the market was selling off because of these fears. I think the worry is that it could maybe make the slowdown that we're seeing economically worldwide a little bit worse, but we'll just have to see how it all pans out.
Yeah, it's definitely on our radar. So that's a good point. So again, we're rebalancing the portfolio. We're looking at our sector weightings. Maybe we'll pick up some more value. Maybe we'll pick up some more gold exposure. And then obviously paying very close attention to the geopolitical landscape and making sure that we have our clients' assets protected in case things do get a little bumpy. Right. I know you've written a great blog about this that you can go out there and find at falconwealthadvisors.com under our content tab. Jesse does produce a weekly blog, but he's done a 2020 outlook where he'll go in a little bit more detail on some of these subjects. Was there anything else that you wanted to bring up for today's show?
I think the last thing, so we talked about how large cap growth outperformed last year. Large caps in general outperformed the market by a lot. So the two largest companies, Royce & Associates did a study on this. So the two largest companies in the S&P now make up 92% of all small cap market cap.
Wow.
So that is... Historically, that's been about 57%, so it's 3 standard deviations higher than the typical norm. So I think another thing that we could see is small caps outperforming, small and mid caps kind of coming back into the fore and maybe outperforming large caps.
Now, I know you wrote in your blog that historically small caps do outperform.
Right.
So again, we are big believers at Falcon Wealth Advisors and mean reversion.
Mm-hmm.
So the idea is that they've been underperforming. So if you're going to get back up to the averages, they're going to have to start outperforming.
And it's such a historic extreme
That is 3 standard deviations is a lot.
that it's tough to ignore.
Right, right. So good. So that's another piece that we'll definitely be looking at in our portfolio. And again, one of the differentiators for us is that the fact that we use individual stocks and bonds in our portfolio for our clients is that Jesse and I and the rest of our team were able to make these tactical shifts and know exactly what we're doing for our clients versus outsourcing it to a mutual fund or annuity company where, again, you lose a lot of control and transparency when that happens. So that's something that our clients value very much so. It's probably one of the top things that our clients appreciate is that the transparency that we're offering by selecting individual stocks and bonds on their behalf. So good. So thank you for that. It's a lot to look at. It's been a heck of a year. I think, again, a lot of clients are obviously very happy with their returns, but you want to be careful, right? You don't want to do what like I called round tripping it. You don't want to ride a market up and then see all of it go back down. So you want to be smart. You want to capture those gains while you have them and then rotate in some other sectors that maybe haven't done as well where we see some opportunity.
Right.
Perfect. Well, thank you, Jesse. And since it's been a while since I've had you on the show, I wanted to do a bird of prey lightning round. So will you entertain our audience here? I've only got 5 questions for you, so we'll keep it kind of easy. So again, this is the bird of prey lightning round sponsored by Falcon Wealth Advisors. You let me know when you're ready.
I'm ready.
Okay, and we're not going to hold you to any of these answers. Okay. So again, feel free just to whatever top of mind. Okay. So as of the filming of this show, the Chiefs were still in the playoffs. I want to get your Chiefs prediction. How far do they get and what happens?
They're playing the Texans, right?
Yeah.
So they lost to them earlier in the season. So I think they'll beat the Texans. And then I don't think they're going to make it to the Super Bowl.
So it'll be Baltimore or Tennessee if they beat the Texans.
I think Baltimore's going to the Super Bowl.
Okay. So you think we'll go to Baltimore and lose?
I think so.
Okay.
I think it's Baltimore's year.
They look pretty good.
I feel like all the stars are aligning.
That quarterback's legit, isn't he? He's kind of emerged out of nowhere. You know, in my fantasy football league, I don't think he was drafted.
Yeah, I'm sure he was.
So
a lot of people said that he should be a wide receiver and not a quarterback. So,
good for him.
Now he's the MVP. So.
Yeah, that's awesome. Okay, what about the S&P in 2020? What's your prediction as far as the return is concerned?
I don't think it'll be 2019. This is not a very bold call, but I think it'll be between the 5 and 10% range, 5 to 15% range. I think
that's pretty wide.
I think. Well, I don't think it'll be negative.
Okay.
If you want an
will it be above average or below average? If average is 9-ish, right? Do you think it'll be a below or above that?
So typically, the market has outperformed in years where it's gone over 20% the year after.
Okay, so the momentum has carried it through the next year.
But the thing about that is that there is a presidential election, so I think it'll hinge a lot on that. Like, the reality is, if Trump is reelected, then the market likes incumbents because they know what to expect.
Right.
With a new president from a different party, they don't really know what.
It's a lot of unknowns.
Expect.
Sure.
Yeah. So I think that could be one thing that overhangs the market. So that's why I'm saying that 5 to 10% range because
Okay, so you're going 5 to 10.
Yeah, we'll go 5 to 10.
Okay.
Just to narrow it down.
Okay, perfect. But good, I like it. So you just brought up Trump. So do you think Trump will be reelected?
I think that's a tough one. This is like one of the most impossible things to
Yeah, it's a little ways out there.
project, but I think yes. I think probably yeah.
All right, and then what about a recession? When is the next recession? It's been, I don't know, over a decade since we've had one. When's the next one?
Another tough question. Probably harder than the one before. I would say it won't happen in 2020. I think the economy it slows, but it steadies in 2020. And I don't think the market is going to do as well. But I don't think we have a recession in 2020. That's all I'll say. I don't know if I can predict when the next one will be, but I don't think it's going to be this year.
All right, good. We like that. And then I know you're a big movie guy, so what is your give our audience one movie rec?
Knives Out is in theaters right now.
Oh yeah, you told me that one.
Murder mystery movie that I really like. And then a movie I just watched over the weekend. It's called The Lighthouse. It has Willem Dafoe and Robert Pattinson, and it's It's shot in black and white, and
Interesting.
it's a really good movie. So it's kind of a horror film, but more of a psychological thriller.
Interesting.
So it's a good movie.
All right, there's some movie recs for you. Well, thanks again. This is all the time that we have for today. I know you got to get back in there and do some trading, but thank you all for tuning in. As always, you can find us out there on all the various social media platforms. So on Facebook, Instagram, Twitter, and LinkedIn. Jesse, I know you probably prefer email. If you have a question directly for Jesse, you want to...
Yeah, my email is just Jesse at Falcon Wealth Advisors.
Perfect. Yeah, and my email is Jake at Falcon Wealth Advisors. Thank you again for tuning in, and we hope you all have a great week.